In the world of investing, it's important to have options, right? Options are financial instruments that can provide you with a variety of strategies to navigate the market. They can be complex, but understanding them can open up new avenues for profit. And I mean that literally. Options give you flexibility. They allow you to hedge against potential losses or speculate on future price movements. Whether the market is going up, down, or sideways, there's usually an option strategy that can fit your outlook. They can help you profit in different market conditions. For instance, you can use options to protect your portfolio during volatile times or to generate additional income when the market is stable. One strategy I want to talk about today is the short call option. This is a more advanced strategy that involves selling call options on stocks you believe will decrease in value. Now, short calls aren't for the faint of heart. They require a good understanding of the market and a willingness to take on significant risk. But for those who are prepared, they can be a powerful tool. Therefore, when you're feeling bearish, in other words, when you expect the price of a stock or the overall market to decline, that means you believe a stock or even the entire market is headed downwards. This belief is crucial because the success of a short call strategy hinges on the stock price falling. This strategy lets you potentially profit from that decline. By selling a call option, you collect a premium from the buyer, which can be a source of income if the stock price drops as you expect. Think of it like renting out your car. You're allowing someone else to use it for a fee, hoping that it will come back to you in good condition. You're betting that your car will come back to you without too much wear and tear. Similarly, with a short call, you're betting that the stock will not rise significantly, allowing you to keep the premium. In this case, you're renting out a stock you think will go down in price. If the stock price stays the same or decreases, you get to keep the premium without any further obligations. But remember, with any investment strategy, there are risks. If the stock price rises significantly, you could face substantial losses, as you'll be obligated to sell the stock at a lower price than the market value. We'll dive into those too. It's crucial to understand both the potential rewards and the risks involved in short call options before diving in. So buckle up and let's explore short call options together. By the end of this, you'll have a clearer understanding of how to use this strategy effectively and responsibly. Why would you want to use short calls in a bear market? Well, because they can be incredibly powerful tools. When you sell a call option, you're essentially betting that the underlying stock won't rise above a certain price by a certain date. Imagine this. The market is slumping and you're convinced a particular stock is overvalued. With a short call, you can profit from that belief as the stock price falls, or even if it just stays flat. That's right. Even if the stock doesn't move much, you can still make money. This makes short calls a strategy worth understanding, especially if you're a bit cautious about the market's direction. Now, let's talk about the potential rewards. With short calls, your profit potential is limited to the premium you receive when you sell the option. Think of it like this. You're selling someone the right to buy a stock from you at a certain price. They pay you a premium for that right. That premium is your maximum profit. While the potential for huge gains isn't there, remember, consistent smaller gains can add up over time. It's all about managing risk and making smart choices. Here comes the challenging part. Short calls have unlimited risk. Yes, you heard that right. Unlimited. Remember how you're selling the right for someone to buy a stock from you? Well, if that stock price skyrockets, you're on the hook to sell it to them at the agreed-upon price, even if it's now worth much more. That's why it's crucial to be comfortable with the potential for losses before using this strategy. Don't put yourself in a position where a big loss could wipe out your savings. Monthly income machine, generating cash flow with short calls. One of the most attractive things about short calls is their potential for generating income. Remember those premiums we talked about? Those can provide a steady stream of cash flow, especially if you're selling options with short expiration dates. This strategy is often used by investors seeking to supplement their income or to generate cash from a flat or slightly declining stock portfolio. But remember, with greater income potential comes greater risk, so proceed with caution. Tesla in the crosshairs, a real-world example of short call options. Let's bring this strategy to life with an example. Tesla, ticker symbol TSLA. Tesla is one of the most talked about stocks in the market, known for its volatility and rapid price movements. This makes it an interesting candidate for options trading. Let's say you believe Tesla's stock price, currently at $250 per share, is going to decline or trade sideways in the short term. This belief could be based on recent news, technical analysis, or broader market trends. You could sell a call option with a strike price of $260 that expires in 1 month. Selling a call option means you're giving someone else the right but not the obligation to buy Tesla shares from you at the strike price of $260. For this, you might receive a premium of $5 per share. This premium is essentially the price the buyer pays you for the option, and it provides you with immediate income. If Tesla's stock price stays below $260 by the expiration date, you keep the $5 premium as profit. This scenario is ideal for you as the seller because the option expires worthless, and you get to keep the premium without having to sell any shares. However, if Tesla's stock price shoots up to $280, you'd be assigned on your short call and forced to sell the shares at $260, even though they're worth more. This means you miss out on the additional gains above the strike price, which can be a significant opportunity cost. This example illustrates both the potential rewards and risks of short calls. While the premium received can provide a steady income, the risk of being assigned and having to sell shares at a lower price than the market value is a real concern. Therefore, it's crucial to carefully consider your market outlook and risk tolerance before engaging in short call options. Taking the reins. Entering a short call option trade. So how do you actually enter a short call trade? It's simpler than you might think. First, you'll need a brokerage account that allows options trading. Once you've got that set up, you choose the stock you want to trade options on. Then, select the cell to open option for a call contract. You'll need to specify the number of contracts, the strike price, and the expiration date. Make sure you understand the potential risks and rewards before you click that confirm button. Exiting gracefully strategies for closing your short call position. Exiting a short call position can be done in a few different ways. You can buy to close the option contract before expiration, which essentially cancels out your position. Or, if the option expires out of the money, meaning the stock price is below the strike price, the contract will automatically expire worthless and you get to keep the premium. However, if the option is in the money, meaning the stock price is above the strike price at expiration, you'll be assigned and forced to sell the stock at the strike price. Theta, the silent ally fueling short call profits. One of the biggest allies for short call traders is a little Greek letter called theta. Theta represents time decay and it works in your favor. As each day passes, the value of an option erodes, and theta measures this erosion. Since short call sellers benefit from this time decay, understanding theta can help you make more informed trading decisions. Weighing the scales benefits and risks of short call options. Short call options can be a powerful tool for investors looking to generate income or profit from a bearish market. By selling call options, investors can collect premiums which can provide a steady stream of income. This strategy is particularly appealing in a market where stock prices are expected to remain flat or decline. However, they come with significant risks that must be understood before diving in. Benefits. Potential to generate monthly income. This can be particularly beneficial for those looking to supplement their regular income or for retirees seeking additional cash flow. Can profit in flat or declining markets. When the market is not showing significant upward trends, short call options can still provide opportunities for profit. Limited upfront capital required compared to buying stock outright. This makes it an accessible strategy for investors who may not have large amounts of capital to invest. Risks *, unlimited risk potential. If the stock price rises significantly, the losses can be substantial, as there is no cap on how high the stock price can go. Potential for significant losses if the underlying stock price increases dramatically. This can lead to financial strain and requires a strong risk management strategy. Before using this strategy, it's crucial to do your homework, understand the risks, and consider whether it aligns with your overall investment goals and risk tolerance. Consulting with a financial advisor can provide valuable insights and help tailor the strategy to your specific needs. Remember, investing always involves risk, and it's essential to protect your hard-earned money. Proper risk management and a clear understanding of the strategy can help mitigate potential downsides and enhance your investment journey. Thanks for watching and good luck with your trading. And do not forget to subscribe and like.